Look at the scoreboard. We're seeing a clear preference for growth today. The NASDAQ 100 proxy, QQQ, is up a decisive 1.00%, leading the charge. The broader S&P 500, SPY, is tacking on 0.66%. Even the small cap barometer, the IWM, is positive at 0.76%. This is the look of a market that smells liquidity and likes the momentum. But look closer. The narrative isn't as clean as the rising indices suggest. While the giants, the mega caps that drive the QQQ, are climbing, we see a subtle fissure opening up in the bedrock of innovation. Nvidia, the engine room of this whole AI rally, is actually shedding 0.10% today. That is a blip, yes, but when the architect of the future starts lagging on a day when everything else is green, you have to ask if the foundation has shifted, even slightly. Contrast that hesitation from NVDA with the outright enthusiasm for pure-play disruptive forces. Tesla is surging by 2.11%. That's a significant move, driven perhaps by Jensen Huang's comments positioning Nvidia's self-driving tech as the next ChatGPT moment, implicitly putting pressure on Elon Musk's dominance. The market seems to be cheering the competitive fire today, even if it dampens the perceived moat of the current AI kingpin. The rest of the big tech cohort, Apple, Microsoft, Amazon, are all modestly green, ticking along as expected. They are participating in the general optimism, but they aren't leading it. The market leadership today is broad, but the best performers are the risk-on names and the disruptors. The players whispering in the halls of power are making noise, and that noise is creating ripples. We have the ongoing drama surrounding Federal Reserve Chair Jerome Powell. The sheer headline that federal prosecutors are investigating the Fed chair, as reported by the New York Times, is a level of political volatility we rarely see directed at the central bank's head. Yet, Powell himself issues a formal statement, calm and measured, straight from the Fed board. The market seems to be applying the classic filter: ignore the political noise, trust the data releases. They are choosing to believe Powell's official word over the investigative chatter. Meanwhile, across the pond, Christine Lagarde's ECB is keeping the monetary lid on things, evident as the EUR-USD exchange rate ticks up by 0.27% to 1.17, likely aided by Bulgaria joining the Eurozone. That's a sign of deeper European integration, which is generally constructive, but it also reinforces the narrative that the ECB is moving at a different pace than the Fed might eventually have to. We also see Elon Musk news. Trump indicating he'd talk to Musk about restoring Iranian internet. This is classic geopolitical maneuvering intersecting with tech magnates. It's tangential to the S&P, but it reminds us that the VIPs are playing on multiple global chessboards. Then there's the institutional commentary. Jim Cramer is trashing the valuation multiple of JP Morgan, an insult to Jamie Dimon. That's the street trying to find cracks in the established financial giants. But look at where the true believers are. Michael Saylor doubles down on his trifecta: digital intelligence, $NVDA, digital credit, $MSTR, and digital capital, $BTC. Saylor's narrative is gaining traction today, fueled by the crypto rally and the NVDA strength. Contrast that bullish conviction with the cautionary tale from Ray Dalio. The legendary investor warning of a final hurrah before a bubble bursts. That's the ballast of skepticism needed in a risk on tape. And finally, the confirmation that Warren Buffett has officially retired, a symbolic passing of the torch, forcing us to look at how to capture his wisdom in the future, often meaning buying those high-quality, stable names that are not leading the charge today. If the equity market is a teenager running too fast, the bond market is the worried parent looking at the speed limit sign. The 10-year Treasury yield, TNX, is down 0.29%, settling at 4.17%. This is crucial. Yields are falling. When yields fall, it means the price of the bond is going up, implying that investors are buying safety, or perhaps, buying the expectation of future economic cooling or lower rates. This creates a disconnect. Equities are rallying on optimism, but the safety net, the 10-year, is tightening its grip. Why? Because the forward-looking data is flashing yellow. We have the headline that US inflation CPI is expected to pick up after a muddy November. This expectation of higher inflation colliding with falling treasury yields suggests a complex market dynamic. Investors might be buying bonds because they believe the Fed will be forced to pivot sooner than expected due to sticky inflation, or because they anticipate a sharp growth slowdown that will necessitate rate cuts later. The market is essentially betting against the Fed's current trajectory, pinning hopes on lower yields. This yield compression provides the lower discount rate that artificially boosts the present value of long-duration growth stocks, which is why the QQQ is soaring. The bond market is setting the table for the tech rally, even if the inflation data threatens to spoil the meal. The narrative driving central banks right now is divergent growth and inflation paths. In the US, the shadow of the Federal Reserve looms large. We are awaiting the next move, but the chatter about Powell's investigation only heightens the sensitivity around any forthcoming data. If inflation picks up, the Fed faces the unenviable choice: fight inflation and risk tipping the economy into recession, or pause and risk losing all credibility. Over in Europe, Lagarde and the ECB are holding steady, allowing EUR/CAD to climb above 1.6200. This relative hawkishness, or at least, stillness, compared to the US environment, is what's supporting the euro and suppressing the dollar slightly, evidenced by EUR/USD equals X being up 0.27%. We must also consider the UK. The UK GDP report is looming, alongside the inflation data. As GBP/USD consolidates, the market is waiting to see if the UK economy can avoid the stagnation that plagues so many developed nations. If the UK falters, it adds global risk to the equation, which ironically can sometimes send money back to US Treasuries, further suppressing those yields. The global central bank consensus is fracturing, and the market is trying to price in which regional bet, US growth or European stability, is the better one for the next 90 days. While we don't have specific commodity prices, the actions of the VIPs give us clues. Mark Zuckerberg is signing massive nuclear energy deals for Meta, citing the need to secure America's global leadership position. That signals a high-level recognition that energy security and massive, reliable power supply are paramount for the next generation of digital infrastructure. Think data centers for AI. This isn't just about social media, it's about national capability. This desire for secure, massive power fuels the long-term demand narrative for energy infrastructure, even if short-term inflation data suggests a temporary slowdown. The VIX, our fear gauge, is dropping sharply by 6.21% to 14.49. A VIX below 15 means complacency is setting in. Investors are so focused on the immediate upside provided by falling yields and sector momentum that they are willfully ignoring the geopolitical and domestic inflation risks bubbling under the surface. The market is pricing in a soft landing today, betting that volatility will remain muted. Let's drill down on the movers. The clear winner is TSLA at plus 2.11%. This is a confidence vote in Musk's strategy, perhaps fueled by the perception that Nvidia's foray into autonomous driving makes the race tighter, potentially creating more upside if Tesla can maintain its lead against a new AI powerhouse competitor. On the flip side, NVDA, minus 0.10%, is the one we must monitor. It's not a crash, it's a breather. Jensen Huang is positioning his hardware as the necessary layer for every cognitive task, including self-driving. The market is digesting that competitive threat. The established tech cohort, AAPL, MSFT, AMZN, are behaving like steady anchors. They're benefiting from the overall risk on tide but aren't the stars. This is a classic market rotation. Money flows into the next big thing, TSLA in this context, when the current champion, NVDA, pauses for breath. We also note the whispers around real estate ETFs, GQRE versus REIT, signaling that institutional money is actively debating where to place large bets in the physical economy, despite the dominance of digital assets in the headlines. Digital assets are confirming the risk on sentiment, albeit with their usual volatility. Bitcoin, BTC/USD, is up 0.55% near $91,322, and Ethereum, ETH/USD, is up 0.45%. They are moving in lockstep with the broader tech indices. This performance reinforces Michael Saylor's thesis today. Digital assets are functioning as a high beta play on digital intelligence. When NVDA shows any sign of weakness, capital flows immediately to BTC as the purest expression of digital value. The proximity of Bitcoin to the $100,000 mark is generating significant psychological momentum. It's noteworthy that Larry Fink's influence, or rather, the institutional readiness implied by Coinbase's rising ranks ahead of US regulatory clarity, suggests that while retail traders are celebrating the price action, the real infrastructure build-out is happening behind the scenes. The smart money is preparing for mass adoption, giving the current 0.5% gains far more structural support than they might appear. The complexity of the tape today is the tension between the macro headline and the market execution. Macro data suggests inflation is sticky and unemployment dynamics are shifting due to immigration policy changes, factors that usually necessitate Fed tightening. Yet, the market executes by buying growth, QQQ, embracing speculative momentum, TSLA, and pushing down the signal of fear, VIX dropping. This suggests the market is prioritizing the technical reality. The cost of capital, bond yields, is softening, which is a powerful tailwind for valuations, regardless of what CPI or jobs reports ultimately print. Traders are saying, "We'll worry about inflation next month. Today, we trade the falling discount rate." We have major geopolitical data coming on the UK front, and the shadow of the Powell investigation will linger. Any unexpected volatility in those peripheral data points could quickly reverse the complacent VIX reading. Today, we are witnessing the market pricing in optimism built on an unstable platform. The rally is real, fueled by the promise of tech dominance and lubricated by falling treasury yields. But the warnings are audible. Inflation risks are ahead, volatility is unnaturally subdued, and the chief architect of monetary policy is under political siege. Keep watching NVDA for directional leadership, and keep listening to the Carrot TNX. Today, they are arguing, and the stocks are currently siding with the bond market's desire for lower rates, not the inflation data's fear of higher prices. Tread carefully. We are riding momentum, not certainty. That's your close-up for today.